There is a profound and dangerous myth at the heart of modern achievement. It's a story whispered in boardrooms, shouted in motivational seminars, and encoded into the very DNA of how we pursue our goals. The myth is that the path to success is paved with brilliance. It's the idea that winning is an act of creation, of forging ahead, of having the one great idea that unlocks the future. We are taught to ask, how can I succeed? We draw up blueprints for victory, we brainstorm pathways to our desired outcome, and we focus all our energy on that gleaming, distant peak. But what if this is not just wrong, but the most reliable way to guarantee failure? What if the secret to building something truly magnificent, a legendary investment portfolio, a lasting business empire, a life of profound meaning, is not found in the relentless pursuit of being right, but in the obsessive, systematic, and ruthless avoidance of being wrong? This is the central operating principle of one of the greatest capital allocators in human history, Warren Buffett, and it is a principle he borrowed from his partner, the intellectual titan Charlie Munger. It's a mental model so powerful, yet so counterintuitive, that it acts as a permanent antidote to the brain's most dangerous tendencies. It is called inversion. Instead of asking how to achieve success, you ask the opposite. What could cause this to fail completely? Instead of brainstorming for brilliance, you brainstorm for stupidity. You identify every possible path to ruin, every conceivable mistake, every potential act of self-sabotage, and then you build your entire strategy around avoiding them. This isn't pessimism, it is the ultimate form of realism. It's the art of winning by not losing. It's the understanding that great things are often built not by moments of genius, but by the absence of catastrophic foolishness over a very long time. Today we are not just going to talk about this idea, we are going to deconstruct it piece by piece and install it as a permanent piece of your own thinking. We will explore the minefield of failure, the power of subtracting weaknesses, the discipline of staying within your intellectual borders, the war against your own psychology, and the unbreakable mathematics of prudence. This is not another list of success tips. This is a complete rewiring of your approach to problem solving, a masterclass in risk management, and the final promise that separates the fleetingly successful from the enduringly wealthy. The first step on this inverted path is the most crucial, and the one most people skip entirely. It's the process of deliberately and unflinchingly mapping the terrain of disaster. Before you even think about the summit, you must first identify every single mine, every hidden crevasse, every possible ambush that lies between you and your goal. This isn't about being negative. It's about being a strategist. A great general doesn't just plan his route of attack. He spends most of his time thinking about how the enemy could surprise him, where his supply lines are vulnerable, and what single mistake could lead to a complete rout. He maps the minefield first. For Warren Buffett, the master of this philosophy, even he had to learn this lesson through the bitter sting of a multi-billion-dollar mistake. The story of Dexter Shoe Company is not just a cautionary tale. It is the perfect foundational anecdote for understanding the critical importance of identifying failure points before you fall in love with a success story. The year was 1993. The United States was feeling confident. The Cold War was over, the economy was humming, and Berkshire Hathaway was a juggernaut. Warren Buffett was not just an investor, he was an American icon, a living testament to the power of sound, value-based investing. And he was on the hunt for what he called an easy business, a business with a simple product, a loyal customer base, and a durable competitive advantage, an economic moat. He found what he thought was the perfect candidate in Dexter Shoe Company, based in the small town of Dexter, Maine. On the surface, it was a classic Buffett investment. Dexter was a great American brand. It made sturdy, reliable shoes, had a long history of profitability, and was run by a fantastic family management team led by Harold Alfond. It had everything Buffett looked for: a clear business model, consistent earnings, and a reputation for quality. It felt safe. It felt permanent. He fell in love with the business, so much so that he decided to do something he almost never did. Instead of paying cash, he decided to buy Dexter Shoe using Berkshire Hathaway stock. At the time, he paid 25,203 shares of Berkshire A, which were then worth about $433 million. This, he would later admit, was the most colossal financial mistake of his career. It was a decision that would ultimately cost his shareholders not just $433 million, but billions upon billions of dollars. So what went wrong? Buffett did his usual forward-looking analysis. He saw a great track record, he saw a strong brand, he saw what he believed was a moat, but he failed to sufficiently invert the problem. He failed to ask, with enough rigor, the most important question: how could this seemingly wonderful business be completely destroyed? Had he dedicated as much energy to that question as he did to admiring Dexter's past, he would have uncovered the single, fatal flaw lurking just beneath the surface. That flaw was foreign competition. Dexter's entire business model was predicated on manufacturing its shoes in the United States, in its plants in Maine. For decades, this was a source of strength, a mark of quality. But the world was changing. Trade barriers were falling, and manufacturing was globalizing. Competitors were beginning to produce shoes of similar or adequate quality in low-wage countries for a fraction of the cost. The economic moat that Buffett thought was a wide, unbreachable castle defense was, in reality, a shallow stream that was about to be evaporated by the intense heat of global economics. The durability of the competitive advantage was an illusion. Within a few years, Dexter's profitability collapsed. The brand couldn't command a high enough price to offset its high domestic labor costs. The business went to zero. The $433 million investment was a total wipeout. But the pain was far, far worse than that. Because Buffett had paid with Berkshire stock, the true cost of the mistake compounded over time. Those 203 shares of Berkshire A, as of today, would be worth over $15 billion. That is the price tag of failing to properly map the minefield. It was, in Buffett's own words, a permanent loss of capital, the cardinal sin of his investing philosophy. He had focused on the beautiful story of Dexter's past success and missed the single factor that would guarantee its future failure. This tragic business story is a perfect illustration of a powerful and dangerous flaw in human reasoning. On a cerebral level, Buffett fell victim to two interconnected cognitive biases that inversion is specifically designed to combat: the availability heuristic and confirmation bias. The availability heuristic is our brain's tendency to judge the likelihood of an event by how easily examples of it come to mind. For Buffett, the readily available information was Dexter's decades of uninterrupted profitability, its strong brand recognition, and its all-American success story. These easily recalled facts made the idea of its continued success seem overwhelmingly probable. The idea of its sudden, catastrophic failure due to foreign labor was a more abstract, less available concept. It was a future possibility, not a concrete, historical fact. Our brains are wired to overweight the tangible past and underweight the speculative future, especially when that future is unpleasant. Compounding this was confirmation bias, the mother of all misconceptions. This is our deep-seated tendency to search for, interpret, favor, and recall information in a way that confirms our pre-existing beliefs. Once Buffett formed the initial hypothesis that Dexter was a great, durable business, his brain, like all of our brains would, began to actively seek out evidence to support that conclusion. He looked at the strong financials, the great management, the loyal customers. Every piece of data was filtered through the lens of "this is a good investment." Inversion is the active, conscious effort to fight this bias. It forces you to adopt the opposite hypothesis. This is a terrible investment, and I'm going to prove it. It demands that you actively search for disconfirming evidence. It requires you to ask, what single fact could falsify my entire thesis? For Dexter, that single fact was that their competitive advantage was not based on a unique brand or patent, but on a manufacturing process whose cost advantage was about to be obliterated. By failing to seek out that disconfirming piece of information with sufficient vigor, Buffett made an unforced error of staggering proportions, a mistake that a systematic process of inversion would have likely prevented. So how do we translate this painful lesson into a practical tool for our own decision-making? We need a blueprint, an applied mental model that forces us to map the minefield before we take our first step. The most effective technique for this is known as the pre-mortem. It's a concept championed by the psychologist Gary Klein, and it is the perfect operationalization of inversion for any critical project or decision, whether in business strategy, financial planning, or even personal life. The process is simple, but its results are profound. Step 1. Before you finalize any major decision, whether it's making a significant investment, launching a new product, or hiring a key executive, gather your team or your trusted advisors. Step 2. Announce the following. Imagine it is 1 year from today. We went forward with this plan, and it has been an unmitigated disaster. It failed completely. It's a wreck. Step 3. And this is the most important part. Each person in the room now has 5 to 10 minutes to independently write a detailed narrative history of that failure. They must tell the story of how it all went wrong. What was the sequence of events? What did we miss? Where were we arrogant? What assumptions proved to be false? The goal here is to get specific. Don't accept vague answers like poor marketing. Demand detail. Our marketing message was tone-deaf to the cultural shift happening with our target demographic, which our competitor exploited by launching a viral campaign on a new social media platform we had dismissed as a fad. Don't accept bad hire. Demand the story. The new CEO we hired had a brilliant resume, but their autocratic leadership style clashed with our collaborative culture, causing 3 of our most talented engineers to quit within the first 6 months, derailing the product roadmap. Step 4. Go around the room and have each person read their story of failure aloud. As people speak, you will notice something magical happen. The psychological safety of assuming failure has already occurred liberates people from the social pressure of appearing negative or not being a team player. It bypasses confirmation bias because the task is no longer to support the plan, but to explain its demise. You will uncover risks that no one had dared to mention. You will see connections between seemingly unrelated departments. The person from finance might point out a cash flow vulnerability that the marketing team was completely unaware of. The engineer might highlight a supply chain dependency that the CEO had overlooked. Step 5. Consolidate all these potential failure points into a master list. This list is now your minefield map. Your project management plan is no longer about just executing the path to success. It's about systematically building defenses, contingency plans, and kill switches for every single identified risk. You are now engineering a system designed to avoid stupidity. This isn't about killing projects. It's about making them stronger, more resilient, and far more likely to succeed because you have paid reality the respect it deserves up front. This systematic, inversion-based approach is the polar opposite of how most people and organizations operate. The path of the 99% is what we can call the vision board approach to planning. It starts with an intoxicating, idealized image of success. The triumphant product launch, the hockey stick growth chart, the financial freedom of a successful exit. Then, they attempt to work backward from this dream, creating a plan where every step is optimized for the best-case scenario. Their business plans are filled with optimistic sales projections, assumes a stable competitive landscape, and often glosses over the boring, mundane, but utterly lethal operational risks. They focus on what to do, creating endless to-do lists, feature roadmaps, and marketing strategies. They almost never create a not-to-do list. They don't have a stupidity avoidance checklist. The dot-com bubble of the late 1990s was the vision board approach played out on a global scale. Companies with no profits and often no viable business model were awarded billion-dollar valuations based on a collective fantasy about a, quote, new economy. The analysis was entirely forward-looking. How many eyeballs can we attract? How big can the market get? The inversion questions were ignored. How could this company burn through all its cash? What happens if our cost of customer acquisition never drops below their lifetime value? How do we lose the trust of our users? What if our entire model is dependent on a continuous supply of venture capital, and that supply suddenly dries up? The failure to ask these questions led to one of the greatest mass extinctions of companies in modern history. Millions of investors who bought into the dream lost everything. It's a stark reminder that a compelling vision for success is utterly worthless if it's not built upon a foundation of rigorous risk management and a deep understanding of all the ways you can fail. The financial connection here is direct and powerful. Thinking this way transforms how you manage money and build value. On a corporate balance sheet, a rigorous pre-mortem process directly translates into a reduction of what accountants call goodwill impairment. When Buffett bought Dexter, he booked the company's value onto Berkshire's balance sheet. When Dexter's value collapsed, that goodwill had to be written down, creating a direct hit to Berkshire's book value and reported earnings. Avoiding a bad acquisition in the first place is infinitely more profitable than managing the fallout from one. For an entrepreneur seeking funding, being able to articulate not just the upside but also a comprehensive plan for mitigating the downside makes you infinitely more credible to sophisticated investors and lenders. It lowers your perceived risk, which can lead to better credit terms, lower interest rates, and a higher valuation. For a project manager, identifying and neutralizing risks up front prevents budget overruns and costly delays, which are direct drains on a company's financial resources. It's the essence of Buffett's famous margin of safety principle, applied to operations. You build in buffers, in your timelines, in your budgets, in your strategic assumptions, to protect you from the inevitable surprises and setbacks. This obsession with identifying the minefield first isn't a defensive crouch, it is the most potent offensive strategy. It preserves your most valuable asset, your capital. By avoiding the big losses, the Dexter shoe-sized mistakes, you ensure that your capital base remains intact, ready to be deployed when a truly great, well-understood opportunity arises. It is the foundational act of all serious wealth preservation and creation. Once you have meticulously mapped the entire landscape of potential failure, the next stage of the inversion process begins. And here again, our intuition leads us astray. When faced with a list of problems and weaknesses, our natural instinct is to add. We add new features, we add more people, we add new rules and complex processes. We believe that strength is built through addition. The inversionist, the Munger and Buffett disciple, understands that enduring strength is most often built through subtraction. It's about building your economic moats not just by having a superior product, but by systematically removing every single thing that could weaken your defenses. It is the subtle but profound power of making things simpler, more robust and more focused by taking things away. This requires a different kind of discipline, a willingness to say no far more often than yes, and an understanding that the most intelligent move is often the one you don't make. There is no better case study for the power of strategic subtraction than Berkshire Hathaway's acquisition and long-term ownership of See's Candies. In 1972, Buffett and Munger purchased the California-based chocolate company for $25 million. At the time, it was a good but not spectacular regional business. Today it has generated over $2 billion in pre-tax earnings for Berkshire, requiring very little additional capital investment. It is one of the crown jewels of their empire, a perfect forever business. But its success is not a story of brilliant innovation or aggressive expansion. It is a story of what Buffett and Munger didn't do. It's a masterclass in subtraction. After they bought See's, the temptations of modern business management were all around them. Business consultants would have advised them to leverage the brand. They would have proposed launching See's branded ice cream, See's cookies, or See's granola bars. They would have pushed for a massive expansion into supermarkets, to get the product into every corner of the country. They would have suggested cutting costs by using slightly cheaper ingredients, perhaps replacing the high-quality vanilla with a synthetic alternative to boost profit margins. They would have recommended plastering the See's logo on everything and anything to increase brand awareness. Buffett and Munger did none of this. They subtracted all of those temptations. They inverted the problem. Instead of asking, how can we grow C's as fast as possible? They asked, how could we destroy this wonderful business? The answers were obvious. You could destroy it by cheapening the ingredients, which would erode the customer's trust in the quality of the product. You could destroy it by overexpanding, diluting the brand's special, gift-like status, and turning it into a common supermarket commodity. You could destroy it by plastering the name everywhere, cheapening its cachet. So their strategy became a not-to-do list. Don't change the recipes. Don't compromise on ingredients, ever. Don't expand so quickly that you compromise the quality control and the customer experience in the stores. Don't put the C's name on inferior products. By subtracting these potential mistakes, they preserved the core of what made C's valuable, its powerful brand, and the pricing power that came with it. Customers trusted C's. They associated it with quality and nostalgia. This allowed C's to regularly raise prices to match inflation and then some, without losing customers. The moat wasn't the chocolate itself. It was the brand perception in the customer's mind, a perception that Buffett and Munger protected by ruthlessly subtracting any action that might tarnish it. The psychological principle at play here is a powerful counteragent to two common human flaws, the action bias and omission bias. The action bias is our innate tendency to favor action over inaction, even when inaction is the more rational course. In business, in investing, and in life, when faced with a challenge or an opportunity, we feel a deep-seated psychological need to do something. A stock portfolio is down, the urge is to sell something, buy something, change something. A competitor launches a new product, the urge is to immediately launch a counter-product. Doing nothing feels like passivity, like weakness. Buffett and Munger have trained themselves to see the immense power in patient inaction. They understand that often, the highest leverage activity is avoiding a stupid activity. Related to this is omission bias, our tendency to judge harmful actions as worse than equally harmful inactions. For example, most people would feel more guilt if their investment choice lost money than if their choice to invest in something that then went up cost them the same amount. We are more afraid of the sting of direct failure from an action than the silent, invisible cost of a missed opportunity or a slow erosion from inaction. The inversionist flips this. They understand that the failure to subtract a weakness, the failure to say no to a tempting but flawed idea, is an action in itself, an action with devastating consequences. For them, the sin of omission, failing to remove a potential source of ruin, is far greater than the sin of missing out on a potential gain. This mindset allows them to sit patiently for years, doing nothing, while they wait for the perfect opportunity, and to manage their existing businesses by focusing on what not to break rather than what to add. To apply this principle of subtraction, we can borrow a mental model that, while often associated with the writer Nassim Nicholas Taleb, aligns perfectly with the Buffett-Munger philosophy of wealth preservation. It is the barbell strategy. This isn't just an investment technique, it's a way of structuring your decisions to eliminate the risk of ruin while still allowing for upside. Here is the blueprint. Step 1. Take the vast majority of your resources, let's say 80 to 90% of your investment capital, your time, or your business's core focus, and place it in extremely safe, robust, and predictable ventures. These are your don't lose bets. In investing, this could be a portfolio of index funds, government bonds, or a collection of C's candies-like businesses that are highly unlikely to go to zero. In business strategy, this is your core, profitable product line that you protect at all costs. The defining characteristic of this side of the barbell is that it is protected from catastrophic failure. You have subtracted the possibility of a knockout blow. Step 2. Take the remaining small portion, 10 to 20%, and allocate it to high-risk, high-reward opportunities. These are what Taleb calls positive black swan bets. In investing, this could be a small allocation to venture capital, angel investing, or even speculative assets like cryptocurrencies, with the full understanding that this entire portion could go to zero. In business, this is your R&D department, your moonshot projects. The key, is that this portion is strictly capped. Its complete and total failure cannot mortally wound you. The barbell strategy is a masterpiece of subtraction. What have you removed? You have removed the mushy, dangerous middle. You have subtracted the moderate risk investments or strategies that have a non-trivial chance of a large loss, but don't have the explosive upside of a true speculative bet. You've eliminated the possibility of taking a supposedly safe bet that turns out to have hidden, fatal flaws. By structuring your affairs this way, you make yourself anti-fragile. The safe portion of your portfolio ensures your survival and slow, steady compounding. The speculative portion gives you exposure to massive upside, but at no point are you ever at risk of being wiped out. You have won by first ensuring you cannot lose. The antithesis to this disciplined approach of subtraction is the dominant ethos in much of the modern business world, the growth at all costs mindset. This is particularly prevalent in the technology and startup sectors, fueled by a constant fire hose of venture capital. The focus is always on addition. Add more users, even if they are unprofitable. Add more features to the product, even if it creates a bloated and confusing user experience. Add more employees, even if it destroys the company culture. The key metric is top-line growth. The story you tell investors is about market share and total addressable market. Profitability is a problem for tomorrow. This philosophy creates incredibly fragile organizations. They are brittle. They are dependent on the next round of funding to cover their massive cash burn. Their business models are often complex and unproven. They lack the simplicity and robustness of a business like See's Candies. We saw this play out with countless unicorns that achieved massive valuations based on growth narratives, only to see their value collapse when the market turned and the easy money disappeared. Companies like WeWork are a perfect example. They took a simple business, renting office space, and added a layer of tech branding, a cult-like culture, and an insane growth-at-all-costs strategy funded by billions in venture capital. Instead of subtracting risks, they added them at every turn, taking on long-term leases while offering short-term flexibility to customers, creating a massive asset-liability mismatch. The result was a near-total implosion. This is the path of the 99%, a relentless focus on addition that ignores the fundamental fragility being built into the system. The financial power of subtraction is most clearly visible in one of Warren Buffett's favorite metrics, return on invested capital, or ROIC. A company like See's Candies is a financial marvel because it generates enormous profits while requiring very little new capital to be invested back into the business. This is the direct result of subtraction. By time chasing unprofitable growth. By time first sign by time by time they keep their invested capital base extremely low. This results in a sky-high ROIC. This, in turn, generates a gusher of free cash flow, cash that isn't needed to maintain the core business. This free cash flow is the engine of Berkshire Hathaway. The cash from See's can then be reallocated to buy other businesses, stocks, or bonds. It's the ultimate example of capital efficiency, born from restraint. A business that is constantly adding, constantly pursuing growth at all costs, is often a capital incinerator. It may be growing its revenues, but its ROIC is terrible because it has to pour every dollar it earns, and then some, back into the business just to stay on the treadmill. The subtraction-focused business becomes a capital generator. This principle of capital efficiency is the financial bedrock of compounding. By subtracting the stupid decisions, the wasteful projects, and the diversifying acquisitions, you are left with a lean, powerful, cash-generating machine whose output can be used to build ever greater wealth. Having mapped the minefield and learned to strengthen our position through subtraction, we arrive at the next great challenge of the inversionist. The world bombards us with an infinite stream of opportunities, ideas, and investments. The temptation is to try to understand them all, to have an opinion on everything, to chase every shiny new object. The forward-looking approach is to ask, among all these opportunities, where can I find the biggest winner? The inverted approach, the Buffett and Munger approach, is far more powerful. It starts with a question of profound humility. Among all these opportunities, where am I most likely to be a complete and utter idiot? This leads to one of their most famous concepts, the circle of competence. It is the idea that you don't have to be an expert on everything. You only have to know the perimeter, the very edge, of your own knowledge. The goal is not to expand that circle, but to know precisely where it ends, and to never, ever make a major decision outside of it. It is the ultimate inversion of the problem of opportunity. The most famous demonstration of this principle in action was Warren Buffett's resolute refusal to participate in the technology stock bubble of the late 1990s. As the Nasdaq soared to dizzying, unprecedented heights, Buffett and Berkshire Hathaway stood on the sidelines. Technology was changing the world, and companies like Microsoft, Cisco, and a swarm of new dot-coms were making people rich overnight. And Warren Buffett, the Oracle of Omaha, was buying bricks and carpets. He was publicly ridiculed. Magazine covers and financial news channels were filled with pundits declaring that the old man had lost his touch. His value investing principles, they claimed, were obsolete in this new economy. The pressure to join the party must have been immense. His shareholders were watching their neighbors get rich on tech stocks while Berkshire's stock trailed the market. But Buffett did not budge. He wasn't asking the same question as everyone else. Everyone else was asking which of these tech stocks is going to be the next Microsoft. Buffett was asking an inverted question: how can I lose my shareholders' money in this sector? His answer was simple and honest. Very easily, because I do not understand it. He didn't understand the technology. He couldn't confidently predict which companies would have a durable competitive advantage in 5 or 10 years. He couldn't look at their financial statements and feel the same level of certainty he felt when looking at Coca-Cola or Gillette. The entire sector was, for him, a black box. So he did nothing. He admitted his own ignorance. He defined technology as being squarely outside his circle of competence. When the bubble inevitably burst in 2000 and 2001, the Nasdaq lost nearly 80% of its value. Trillions of dollars of speculative wealth evaporated. The pundits who had mocked Buffett were silenced, and Buffett, with his massive pile of cash preserved from the carnage, was able to go on a buying spree, picking up wonderful assets at bargain prices. His decision not to invest was not based on a prediction that the bubble would pop. It was based on a simple, humble, and inverted assessment of his own limitations. He didn't try to find the winner. He simply chose not to play in a game where he knew he could be a catastrophic loser. This discipline is a direct psychological defense against one of the most insidious cognitive biases, the Dunning-Kruger effect. This is the phenomenon where individuals with low ability or knowledge in a particular domain tend to overestimate their own competence. In short, it's the bias of being too ignorant to recognize your own ignorance. We see this everywhere in the world of investing. The novice trader who has a few lucky wins and suddenly believes they are a market genius. The business executive who has success in one industry and assumes that success will easily translate to another, completely different industry. The Dunning-Kruger effect is a killer because it gives you the confidence to make big bets in areas where you have big blind spots. The circle of competence is a formal, systematic tool for neutralizing this effect. By forcing yourself to explicitly define what you know and what you don't know, you are making a conscious declaration of your own potential for incompetence. It's an act of intellectual humility. Inversion here is about flipping the default human assumption. Our default is to assume competence until proven otherwise. The Buffett-Munger model is to assume incompetence in all areas until you can prove, with overwhelming evidence, a deep and enduring understanding. This simple flip in default settings is a powerful guardrail against the arrogance that so often precedes a great fall. To make this concept of the circle of competence a practical tool in your own life, you can use a simple but powerful exercise I call the 3 baskets blueprint. It's a method for categorizing the world of decisions and opportunities in a way that forces honesty and discipline. Step 1. Take out a piece of paper or open a new document and create 3 columns. Label them in, out, and too hard. Step 2. In the in column, you are going to list the subjects, industries, businesses, and types of decisions that you understand with deep, almost intuitive fluency. This is your circle of competence. The key here is to be brutally, painfully honest with yourself. This should not be a long list. It's not about what you've read an article about or what you find interesting. It's about what you understand at a fundamental level. For a software engineer, it might be enterprise software as a service business models. For a doctor, it might be the healthcare and pharmaceutical industry. For a long-haul trucker, it might be logistics and transportation companies. Be specific. This is the only basket where you are allowed to make significant financial and life decisions. Step 3. In the out column, list all the things you know you don't understand and have absolutely no business making predictions about. For most of us, this would include things like biotechnology, commodities, futures, or complex derivatives. This basket is easy. The discipline is to never let yourself get tempted by anything in it, no matter how exciting the story sounds. Step 4, and this is the most critical, the too hard basket. This is the danger zone. This basket is for all the things that are tantalizingly close to your understanding, but which you can't predict with any real certainty. For Buffett in the late 90s, technology was in the too hard basket. He understood business, but not that specific kind of business. For many people today, cryptocurrencies might fall into this category. They are alluring, you might understand the basic concept, but the competitive dynamics and long-term value are incredibly difficult to assess. The rule of the 3 baskets blueprint is simple. Your entire operational life, your investments, your career moves, your major business initiatives must take place exclusively within the in basket. You treat the out basket as if it doesn't exist, and you treat the too hard basket as a siren song to be resisted at all costs. It is the acknowledgement of this third basket that truly separates the disciplined thinker from the amateur. The opposite of this disciplined approach is the default mode for 99% of people when it comes to making decisions, particularly financial ones. It's the path of FOMO, the fear of missing out. This mode of thinking is driven entirely by external noise rather than internal knowledge. The process is simple. You see something going up in price dramatically. It could be a stock, a cryptocurrency, or a real estate market. You hear stories on the news and from your friends about how much money people are making. You feel a pang of anxiety and envy. You start to think, I need to get in on this. I'm missing out. You do a quick search online, read a few positive articles that confirm the hype, confirmation bias, and then you invest your money. At no point in this process did you stop to ask, is this within my circle of competence? Do I understand the underlying asset, its competitive advantages, and its long-term prospects? Your decision was not an act of investment. It was an act of social contagion. You weren't buying a business. You were buying a lottery ticket because everyone else was. This FOMO-driven decision-making is the engine that inflates speculative bubbles, and it is the primary reason why the average investor dramatically underperforms the market over the long term. They are constantly chasing yesterday's winners, buying high in a state of euphoria and selling low in a state of panic, because their decisions were never anchored to a foundation of true understanding. The direct financial connection of rigorously applying the circle of competence is a dramatic improvement in the quality and risk profile of your long-term portfolio. First, it leads to a massive reduction in what legendary tennis coach Vic Braden called unforced errors. In investing, an unforced error is a loss that stems not from bad luck, but from a bad decision made outside your area of expertise. By refusing to play games you don't understand, you eliminate the vast majority of these self-inflicted wounds. Second, it leads to a much lower portfolio churn. Since you are only investing in things you understand deeply, you are less likely to be spooked by short-term market fluctuations. You have the conviction to hold on through volatility because your thesis is based on fundamentals, not on a fleeting market narrative. Lower churn means lower transaction costs, and crucially lower taxes, which are a significant drag on long-term returns. Finally, operating within your circle allows you to make bigger, more concentrated bets when a truly fantastic opportunity arises within your area of expertise. When Buffett saw the American Express salad oil scandal in the 1960s, he understood the payments business deeply. He knew the scandal wouldn't permanently impair the company's moat, so he bet big and made a fortune. This combination of avoiding stupid losses and being able to act decisively on rare, high-probability opportunities is what generates true, market-beating alpha over a lifetime. It is the financial reward for intellectual honesty. We have now come to the inner sanctum of the inversion philosophy. We have mapped the external minefield, we've learned to subtract external weaknesses, and we've defined the external boundaries of our competence. But the most dangerous enemy often lies not in the world, but within our own minds. The human brain, for all its marvels, is a flawed machine, riddled with cognitive biases, emotional traps, and a deep-seated capacity for self-deception. The final and most difficult application of inversion is to turn it inward, to systematically identify and neutralize the ways in which our own psychology can lead us to catastrophic stupidity. It's not enough to have a good business strategy. You must also have a strategy for not being your own worst enemy. This is the war against the unforced psychological error. Charlie Munger, the grandmaster of this way of thinking, frequently tells a story that perfectly encapsulates this internal application of inversion. It's the story of a World War II fighter pilot. This pilot was tasked with a dangerous but critical job, flying transport planes over the treacherous Himalayas, a route known as the Hump. The planes were unreliable, the weather was unpredictable, and many pilots perished. This particular pilot, however, had an astonishingly good safety record. When asked his secret, he didn't talk about his brilliant stick and rudder skills or his intuitive feel for the aircraft. He talked about his process of inversion. He said that instead of just practicing how to fly the plane correctly, he spent a significant amount of his time asking, "What are all the ways that I could kill myself in this airplane?" He would then go down the list. I could run out of fuel, I could have an engine fire, my landing gear could fail to deploy, the instruments could ice over. For each potential mode of failure, he would then practice the corresponding emergency checklist until it was pure muscle memory. He had inverted the problem of survival. Instead of focusing on the ideal flight, he focused on mastering the response to every conceivable disaster. He had a system for avoiding stupidity under pressure. This is precisely how Buffett and Munger approach decision-making. They don't just trust their intelligence or their gut feel. They use checklists. Their investment process is a formal checklist of questions designed to identify potential failure points. Is the business understandable? Does it have a durable competitive advantage? Is the management trustworthy? Is the price sensible? But it's also a checklist against their own psychological failings. Is our interest in this company being driven by a temporary, exciting story in the news? Are we falling in love with the charismatic CEO and ignoring red flags in the financials? Are we rushing to a decision because we're afraid of missing out? The checklist is not a substitute for thinking. It's a tool to ensure that thinking happens rationally, especially when emotions like greed and fear are trying to take control. It is the pilot's emergency procedure for the mind. The two psychological demons that these internal inversion systems are designed to cage are the affect heuristic and the overconfidence bias. The affect heuristic is a fancy term for a simple, powerful phenomenon, making decisions based on your emotional response to something rather than a rational analysis. If you have a positive affect or feeling toward a product, say you love your new iPhone, you are more likely to believe that Apple stock is a good investment, regardless of its valuation or competitive landscape. Your emotional attachment short-circuits your analytical brain. We do this all the time. We hire the candidate we'd like the most in an interview, even if another candidate has better qualifications. We invest in the story that sounds the most exciting and inspiring. A checklist or a formal process of inversion acts as a mandatory cooling-off period. It forces you to move from "how do I feel about this" to "what are the objective facts and what does my system say?" Then there is the overconfidence bias, which is perhaps the most dangerous trait of intelligent people. The smarter you are, the better you are at constructing sophisticated narratives to justify your own conclusions. You start to believe your own hype. Overconfidence leads you to take bigger risks, to do less due to diligence, and to dismiss dissenting opinions. An inversion checklist is an act of forced humility. It presupposes that you, despite your intelligence, are perfectly capable of making a monumentally stupid mistake. It forces you to prove, systematically, that you are not being an idiot. It is a circuit breaker for ego, a crucial governor on the engine of an otherwise powerful intellect. So how can we build our own emergency checklist for the mind? We can use an applied mental model called the two-column decision-making blueprint. This is a practical method to force an inverted, rational analysis of any major decision. Step 1. Take a major decision you are contemplating. It could be taking a new job, making a large financial commitment, or forming a business partnership. Step 2. Create a document or use a whiteboard with two columns. The first column is titled, "The Seductive Narrative, All the Reasons This is a Great Idea." In this column, you let yourself go. Write down all the optimistic, exciting, emotional reasons you want to do this. This is where you capture the forward-looking success story. This new job has a better title and will impress my friends. This investment could be a 10-bagger. This business partner is so charismatic and connected. This step is important because it acknowledges and isolates the emotional, gut feel part of your brain. Step 3, the second column is titled, "The Idiot Checklist, All the Ways This Could Become a Catastrophe." This is where you invert the problem. Here, you must list not just the external risks, but the internal, psychological traps you might be falling into. Be ruthless with yourself. Here are some prompts. Am I rushing this decision due to an arbitrary deadline or external pressure? Am I suffering from shiny object syndrome, mesmerized by something new? Am I experiencing FOMO, acting because I see others succeeding? Am I falling for the effect heuristic, letting my liking of a person or product cloud my judgment of the actual deal? Am I being overconfident, assuming my past successes guarantee future results in this different context? Am I seeking out disconfirming evidence, or am I only consuming information that supports my desired outcome? Step 4. The hard rule of this blueprint is that you are not allowed to make the decision until you have a clear, written, and satisfactory mitigation strategy for every single point on your idiot checklist. This process feels slow and unnatural. It's supposed to. It is the deliberate application of brakes to a brain that is wired to accelerate toward emotionally appealing conclusions. It is your personal flight simulator for avoiding psychological crashes. This systematic self-interrogation stands in stark contrast to the path of the 99%, which is often dominated by gut-feeling decision-making. Our culture glorifies the maverick leader, the visionary CEO who makes bold bets based on instinct. We love the stories of entrepreneurs who trusted their gut and won big. And while intuition, which is really just subconscious pattern recognition based on deep experience, has its place, relying on it for high stakes, complex decisions is an act of profound arrogance. For most people, trusting your gut is simply a license to let unchecked cognitive biases run the show. When people say they are using their gut, they are often just taking the path of least cognitive resistance. They are looking for reasons to say yes to the things they emotionally want, rather than doing the hard, uncomfortable work of finding the reasons to say no. They don't have a system for challenging their own thinking. They don't separate the seductive narrative from the objective facts. They merge them into one, and then congratulate themselves on their decisive, intuitive leadership right up until the moment their gut feeling leads them off a cliff. The direct financial connection of this internal inversion is the prevention of the single biggest destroyer of wealth, the large, irreversible, ego-driven mistake. For a CEO, avoiding one catastrophic overconfident acquisition can preserve more shareholder value than a decade of small, smart operational improvements can create. The history of business is littered with these deal-of-a-lifetime mergers that turned into value-destroying nightmares, all driven by a CEO's hubris. Think of AOL's acquisition of Time Warner at the peak of the dot-com bubble. It was a decision driven by a grand vision and a soaring stock price, not by a humble, inverted analysis of how it could go wrong. For an individual investor, the financial impact is just as profound. Mastering your own psychology is what allows you to avoid selling everything in a panic at the bottom of a market crash, or leveraging up to buy into a speculative frenzy at the top. These two mistakes, panic selling and euphoric buying, are responsible for the vast majority of wealth destruction among individual investors. By having a system to manage your own internal state, you prevent yourself from making the permanent capital impairments that Charlie Munger warns about. You avoid the zeros. You stay in the game. And in the long run, the person who simply stays in the game, compounding their capital without major setbacks, is the one who ultimately wins. We have now reached the final and most powerful pillar of the inversion philosophy. We have learned to identify the minefield of failure, to build strength by subtracting weakness, to operate only where we are knowledgeable, and to wage war against our own flawed psychology. The culmination of all these practices leads to the ultimate prize, the slow, steady, and inevitable power of compounding. But here, too, inversion provides the master key. The world teaches us to ask, how can I get rich? This question leads to chasing hot stocks, taking on excessive risk, and searching for shortcuts. The inversionist asks a fundamentally different and far more powerful question. How can I guarantee that I never go broke? This shift from chasing gains to obsessively avoiding ruin is the very essence of building lasting wealth. It is the compounding of prudence. Warren Buffett's entire career is a testament to this principle, and it was embedded in his partnership from the very beginning. When he started his first investment partnership in the 1950s, he wrote a letter to his initial investors, mostly family and friends, laying out the ground rules. In that letter, he did not promise them spectacular returns or promise to beat the market every single year. He inverted the promise. He told them, rule number 1 is to never lose money. Rule number 2 is to never forget rule number 1. He set the expectation that his primary job was not one of offense but of defense. His first duty was the preservation of their capital. He explained that he would rather have lumpy, uneven returns on the upside than risk any substantial, permanent loss on the downside. This framed the entire psychological contract around a downside-first philosophy. His partners understood that he was playing a long game, a game where the primary objective was to stay at the table. The incredible, world-beating returns that followed over the next several decades were not the result of a reckless pursuit of growth. They were the natural, mathematical outcome of a relentless focus on not going backward. By avoiding the big drawdowns, the 50% losses that plagued other, more aggressive investors, Buffett's capital base was always intact, always ready to grow from a stable or rising foundation. He understood the deep truth that the engine of compounding works its magic most powerfully on a principle that is never allowed to be severely impaired. The psychological principle that makes this approach so effective is the rational harnessing of one of the most powerful biases in the human mind, loss aversion. Decades of research by psychologists like Daniel Kahneman and Amos Tversky have shown that for most people, the pain of a loss is roughly twice as powerful as the pleasure of an equivalent gain. Losing $1,000 feels twice as bad as finding $1,000 feels good. For most people, this bias leads to irrational financial behavior. It's why they hold on to their losing stocks for too long, unwilling to realize the loss, hoping they will get back to even. It's why they sell their winners too early, eager to lock in the pleasure of a gain. Buffett and Munger, however, take this deep human truth and build a rational system around it. They recognize that while the emotional response to loss may be irrational, the mathematical reality is not. A large loss is objectively mathematically devastating to long-term wealth creation. Loss aversion for them is not a bug to be overcome, it's a feature of reality to be respected. Their entire system of inversion, of checklists, of circles of competence, is an institutionalized framework for honoring the profound power of loss. It transforms a potentially destructive emotional bias into a productive and rational fear that guides them toward prudent, high-quality decisions. They have built a fortress of process to protect them from the tyranny of their own emotions and the even greater tyranny of negative numbers. To truly internalize this, you need a blueprint that connects this philosophy to the stark reality of mathematics. Let's call it the Rule of 72 and the Mathematics of Ruin. It's a two-part mental model. Step 1 is to appreciate the magic of compounding. The Rule of 72 is a simple heuristic to understand this. If you divide the number 72 by your annual rate of return, it will tell you roughly how many years it takes to double your money. An investment that returns a steady 10% per year will double in about 7.2 years. A 7.2% return will double your money in 10 years. This shows the incredible power of consistent, even unspectacular gains over a long period. This is the part of the story everyone loves. But step 2 is the inversion, the part everyone ignores. It's understanding the tyranny of negative numbers, or the mathematics of ruin. If you have $100,000 and you lose 50%, you are left with $50,000. To get back to your starting point of $100,000, you don't need a 50% gain. You need a 100% gain on your remaining capital. The math gets even more brutal. A 75% loss requires a 300% gain to break even. A 90% loss requires a 900% gain. A catastrophic loss is not a linear setback. It is an exponential one. It can put you in a hole so deep that no reasonable future returns can ever pull you out. So the practical blueprint for your entire financial life is to build it around one primary, inviolable rule. Avoid any behavior, any investment, and any level of risk that has a non-trivial chance of causing a catastrophic, permanent loss of capital. Asterisk. This means systematically avoiding things like excessive leverage, which can force you to sell at the worst possible time. It means avoiding speculative bubbles, where assets are priced for perfection. It means avoiding making big bets in areas outside your circle of competence. It is the simple but not easy path of prioritizing survival above all else. This path of prudence is the absolute antithesis of the lottery ticket approach to finance that has become so pervasive in our culture. The lottery ticket mindset can manifest in many ways. It's the day trader trying to scalp pennies on volatile stocks. It's the crypto enthusiast going all in on the latest meme coin. It's the real estate speculator using high-interest, short-term loans to flip houses in a hot market. It's the entrepreneur betting their entire life savings on a single, unproven business idea. The common thread is a complete and utter disregard for the mathematics of ruin. The focus is entirely on the potential upside, the life-changing 10x or 100x return. This path is defined by a constant search for asymmetric returns skewed to the upside, while completely ignoring the possibility of an asymmetric loss skewed to the downside, the 100% loss of capital. People who follow this path may have spectacular, exhilarating wins. Their stories are exciting and make for great headlines. But over any meaningful period of time, they are overwhelmingly likely to experience a loss so profound that it wipes out all their previous gains and permanently sets them back. They are playing a game of Russian roulette with their financial future. They may survive a few pulls of the trigger, but eventually, the law of averages catches up. They are constantly trying to get rich quick, and in doing so they are taking the most reliable path to staying poor forever. The ultimate financial connection of this final pillar is the achievement of true, resilient, and lasting financial freedom. On a portfolio statement, a strategy built on avoiding ruin will likely produce a higher Sharpe ratio, which is a measure of risk-adjusted return. It will lead to a smoother, upward-sloping equity curve over time, without the terrifying 50% drawdowns that shake most people out of the market. But the impact is deeper than just numbers on a page. It's about building a financial life that is robust and anti-fragile. It's about sleeping well at night, knowing that no single market event, no single bad investment can wipe you out. It is the quiet confidence that comes from knowing you have structured your affairs to survive and thrive through the inevitable chaos and uncertainty of the world. Wealth that is built on a foundation of prudence is real. It is durable. The relentless power of compounding, applied to a capital base that is protected by a moat of inverted thinking, is the most powerful financial force in the universe. It is not the fastest way to get rich, it is the surest way. It is the final promise of inversion. By obsessing over the avoidance of failure, you make success the most likely and almost inevitable outcome. You have just spent this time re-architecting your mind. You have installed a powerful piece of mental software, the principle of inversion, that allows you to see the risks that are invisible to others. You have learned to win not by chasing brilliance, but by systematically avoiding stupidity. This is a profound advantage, a tool that can protect and grow your capital, your business, and your life's work for decades to come. But inversion is not a standalone tool. It's a gear in a much larger machine. The genius of Buffett and Munger is not in any single mental model, but in the way they network these models together into a latticework of worldly wisdom. Inversion is the shield. But what about the sword? Inversion tells you what to avoid, but how do you analyze the opportunities that remain? That requires another, equally powerful model that plugs directly into this one. And the video that YouTube is now showing you on your screen is not an accident. Its algorithm has detected that you are on a specific path of learning. It is showing you the next piece of the map. That video on your screen is the link that connects risk management to opportunity analysis. It is the model that turns the capital you have so carefully preserved into the engine of massive growth. Most people will stop here, satisfied with the powerful tool they have just acquired. They will have the shield, but they will never learn how to wield the sword. But for those who are serious, for the true architects of their own future who understand that this is a journey of building a complete mental arsenal, the path continues. The choice to click is not just a choice to watch another video. It is a declaration that you are committed to completing the system. To not just be smart, but to be wise. Continue your ascent.